All right, the closing bell just rang on Wednesday, January 7th. Indices finished pretty flat, right near their daily pivots, but, the headlines really don't tell the story.
Not at all.
So our mission today is a deep dive into the source materials, the trading data, the institutional flows, the volume, to figure out if this new high watermark has any real conviction behind it.
Or if professional money is already setting the trap. That is the core analysis, and you have to look past the noise.
Right.
We have a stack of data proving that while the S&P looks healthy on the surface, the internals are flashing some serious warnings. We need to tell you if this is a platform for a sustained breakout or just an exhausting peak.
A peak that's ready for a pretty violent correction.
Exactly.
Okay, let's start with the scoreboard. It was a day of, market ambiguity.
Yeah.
The S&P 500 managed a fractional gain, just up 0.08%.
Barely green.
Barely. The Nasdaq, on the other hand, slipped 0.12%, so you see that pressure in the high-growth names. And meanwhile, the Dow Jones Industrial Average added a modest 0.15%.
And that flatness, right at the top of the range, that confirms our initial read. This was a classic wait-and-see tape.
A total churn.
It's a low-volume churn. Traders are just refusing to commit capital before the big macro catalyst hit. They're letting passive money hold the line, but there is zero, and I mean zero, active conviction flowing in at these levels.
And the sector split just illustrates that tension perfectly. Energy was the unexpected leader, right? Gaining 1.2% on those supply-side jitters.
Right. Supporting crude prices.
But the flip side of that, technology was the absolute laggard. It shed 0.9%, specifically because profit-taking hit all those overextended semiconductor names.
So what you're seeing is money rotating out of high beta and into commodities.
Yeah.
That is not a risk-on signal.
No.
It's institutional rotation, and it matters a whole lot because tomorrow gives us the ultimate decider for market direction, the PPI print.
The ultimate vibe check.
It is. That data point is either going to confirm the soft landing narrative that the market's already priced in, or it's going to force a sudden, violent repricing of Q1 rate expectations. We are trading on a razor's edge.
Okay, so let's unpack that conviction check. Historically, true breakouts, they need expanding volume. Volume has to support the push to new highs. When we look at the raw data for today, Wednesday, what's the verdict?
The verdict is it's absolutely a low conviction fade. The absence of institutional participation is, it's deafening.
How low are we talking? Give us the hard data. What's the volume compared to the 30-day average? Because volume confirmation is everything at all-time highs.
Everything. So broad market volume across the NYSE and Nasdaq came in at about 92% to the 30-day average.
92%.
That 8% shortfall is critical. And think about the mechanics of it. Volume dried up right as the indices approached those morning peaks.
So no follow-through buyers.
None. This signals that professional desks were basically running on skeleton crews. They were unwilling to commit fresh capital, and they effectively let the natural gravity of profit-taking dictate the direction for the rest of the day.
So if the volume suggests this was a retreat and not a sustained advance, it implies institutions were using the rally as an exit ramp.
A textbook exit ramp.
We saw this play out explicitly in the MOC, right? The market on close orders. What did that final imbalance look like?
It heavily favored the sell side. That signals institutional reluctance, for sure. We saw $1.4 billion net sell imbalance.
$1.4 billion. Wow.
And that selling wasn't spread evenly either. It was really concentrated in financials and, counterintuitively, the energy sectors.
Even though energy led the day.
Exactly.
Okay, that's the part that needs some reconciliation. Energy, XLE specifically, it led the tape all day, yet institutions sold it hard into the close. Why use the MOC for profit-taking in your best-performing sector?
Well, that's the subtlety of high-speed trading, The Venezuela oil transfer news hit the tape late, and that sparked a really quick crude sell-off.
Okay.
So institutions seized that moment, that small drop in price, to execute huge sell orders into a sector that was already inflated. They knew the fundamental narrative was probably peaking.
They used the closing strengths to rotate out.
They did. They rotated out of Trump trade cyclicals like the Energy Select Sector, SPDR, XLE, and went right back toward the relative stability of large-cap tech.
So if the selling volume tells us who is getting out, the reversals we saw in specific stocks tell us how violently they were scrambling for the exits. Let's get into our tired bull list. Let's start with the Dow Jones, the ultimate headline index.
The Dow was a monster head fake. It successfully trapped all that late money. It touched a historic high of 49,630 in early trading.
Sucked them right in.
Sucked them in, drew in all that capital, only to suffer a 200-plus point tumble. closing the day in the red. That's a textbook outside reversal.
And what does that signal typically?
It signals a major near-term price ceiling has just been set.
And some of the most jarring details were in the semiconductors, which have been the darlings of this whole run. Talk to us about the storage names.
Yeah, Western Digital and Seagate, WDC and STX, they demonstrated clear blow-off top behavior. They had these massive surges on Tuesday, just fueled by pure exuberance.
Right.
But today, they reversed their gains completely. They closed down 9% and 7% respectively. When you see that kind of aggressive, high-volume profit-taking, it tells you the fast money has completely hunted the trade.
And it's not just tech. Even the banks are signaling some internal exhaustion. JT Morgan, JPM, it opened strong with the Dow, but it finished down 2.1%.
And the price action in JPM formed what technicians call a classic bearish engulfing candle. It opens higher than the previous day, closes lower than the previous day's open.
Risk and all the gains.
All the gains, and then some. And that pattern, especially in a leading sector like financials, is a very strong signal of a near-term top.
So it's not just equities. Even the traditional safe haven, gold, had a dramatic reversal today.
It did. Gold futures GC had what we call a fake breakout. It pushed right through 44.54. That initial momentum probably sucked in a lot of aggressive retail money chasing the headline.
Of course.
But the institutional sellers were just waiting there, absorbing all that buying pressure. Gold reversed sharply to close at 44.36. When retail rushes in and the price instantly reverses, it means the smart money just unloaded on them.
So we have all these symptoms of institutional hesitation in these individual reversals. Let's connect this now to the structural health of the market. What are the internals, the breadth, telling us about whether these indices are actually supported?
They are shouting fragile. The critical data point here is the advanced decline ratio, the AD ratio. It closed at just 1.2 to 1.
1.2 to 1.
And for context, in a healthy, broad-based rally, you want to see that ratio closer to 3 to 1, maybe 4 to 1, especially at new highs. A 1.2 to 1 ratio just shows participation is incredibly weak.
The classic K-shaped grind. The index looks fine because the top-heavy names are holding up, but underneath, most stocks are already in a correction.
Exactly right. The index stability is just masking underlying rot in nearly 60% of the stocks. Capital is fleeing mid-caps and defensives, and it's aggressively huddling back into the safety of the mega-cap 5.
And if you don't own one of those names, your portfolio is hurting.
It's likely underperforming significantly.
But the most critical piece of structural data here has to be the bearish divergence. Walk us through what that is and why it suggests an imminent mean reversion.
So a textbook bearish divergence happens when the price index, in this case the S&P 500, prints a marginal new intraday high. But a core structural indicator, like the high-low logic index, fails to confirm it.
So the engine is losing power.
That's the perfect analogy. It's like the car's engine is losing horsepower, even though the speedometer is still ticking up just from momentum.
So the internal strength required for a sustained move is decelerating, even as the price inches higher. What does history suggest happens when momentum fails to confirm a new peak?
History suggests a 3 to 5% mean reversion move is imminent. These are truly fragile highs, and the risk is just compounded by the massive VIX complacency. The VIX, the market's fear gauge, dropped almost 6% today, settling at 13.40.
We are squarely in the complacency zone. Help me reconcile this, though. You're saying the market is top-heavy and underhedged, yet the VIX is crashing. Are institutions buying cheap insurance, or are they just ignoring the risk?
They are largely ignoring the risk, and that is the danger. The VIX drop signals a volatility crush. Implied volatility is being vacuumed out of the system.
So insurance is cheap.
It means the cost of portfolio insurance or tail risk hedging is absurdly low right now. Professional money is betting on perfection. And when the market thinks nothing bad can happen, that is precisely when you need to be cautious and put on some hedges.
So we've established the market is top-heavy, structurally weak, and underhedged. The consensus among pro-money is to stay liquid, tighten up risk management. What's the strategy summary for Thursday's session? What's the primary tactical call?
The primary tactical call is simple. Tighten stops on your winners and reduce exposure to mid-caps. The crucial structural watch is still the Russell 2000 of the IWM. If that index doesn't catch a substantial bid by Friday, today's neutral sentiment turns structurally bearish for the whole market.
Let's get highly tactical then. Based on gamma exposure, where are the key technical levels, the floors and the ceilings we need to watch in the S&P?
The critical support, the floor, is 6,125 on the SPX. This is the zero gamma level. And this level is vital because if it's breached, volatility expands rapidly.
Why is that?
Dealers flip. They go from buying dips to selling rips. They have to accelerate their hedging, which can instantly turn a soft drop into a steep correction.
And the ceiling. Where's the resistance that needs tomorrow's PPI print to crack?
You should expect heavy resistance, renewed profit-taking, right at 6,200. Without a macro catalyst that delivers a perfect, clean, soft landing signal, that 6,200 level will likely act as the ceiling for the entire week.
Given this coiled structure, we have to talk about the asymmetric trade setup, the gamma squeeze possibility.
Right, so the specific trade we're watching is long SPY call spreads for the January 9th expiry, but only if the open holds stable.
Okay.
Wednesday's neutral churn left market makers heavily short gamma. This means they have to hedge aggressively, they have to buy stock on any move higher above the daily pivot.
So even small buying volume can trigger a disproportionate move higher as dealers are forced to chase delta. It's a classic risk one to make four setup.
Exactly. You're leveraging the mechanics of the market maker's own positioning.
Yeah.
It's a coiled spring waiting for a trigger.
Got it.
However, given that Wednesday printed a neutral, balanced profile, we have to temper expectations for a major trend day tomorrow.
So what's the statistical edge telling us about chasing the open?
The statistical continuation probability for a major trend day is only 22%.
That's low.
It's very low. The edge actually favors a two-sided morning, so we would strongly advise against chasing the opening 15 minutes. We are more likely to see a look above and fail at Wednesday's high before any real direction is found. Patience is key.
Let's finish with the specific day two momentum watch list, the tickers, where you can still see that institutional accumulation despite the overall market fatigue. Let's start with NVDA.
NVDA saw a late session breakout of a 3-week bull flag,
Okay.
and this was triggered by massive dark pool prints. This is a classic high-tide flag entry setup.
Take for finding the big money, though.
You're following the big money. Institutional reallocation for Q1 is prioritizing semis. If it holds the $172.50 level in the first hour of trade, the target moves very quickly to $180.
And the high conviction short squeeze candidate, the one that's signaling retail is lagging behind institutional accumulation. Palantir, PLTR.
Yeah, PLTR formed a massive volume shelf on Wednesday's close. So the play here is a gap and go. If it opens above Wednesday's VWAP, which is $74.20, the short sellers are trapped.
And they have to cover.
They have to cover aggressively. This is a classic short squeeze candidate for Thursday, suggesting that even while the market looks tired, smart money is still accumulating very specific high-growth assets.
Okay, bring it all home for us.
So to connect the dots back to the macro picture, the fade we saw today could easily escalate into a broader correction if the cooling labor market, and we need to watch that 4.6% unemployment level and Friday's payrolls, continues while the Fed remains stubbornly hawkish.
Which means we are trading in a show-me market, right? It favors the patient trader who lets the dust settle after the PPI print instead of gambling on the current index levels.
Absolutely. The strategy is clear. You wait for the 6,125 test. If that zero gamma level holds, we have our path to squeeze up to 6,200.
And if it snaps?
If it snaps, you need to be tactical, you have to be hedged immediately, and you need to be extremely nimble.
That's the analysis you need to navigate Thursday's open. Stay tactical, stay patient. We'll break down the data for you after the next close.